Governments often claim that they work to protect your financial independence. They speak of stability, economic growth, and opportunities for success. Yet, history paints a far more complex and darker picture. Throughout human history, states have used hidden financial strategies to increase their wealth and consolidate power, leaving ordinary citizens with less. These tactics are not new. They have resurfaced across centuries in different forms, but the objective remains the same: to transfer wealth upward and keep the majority dependent. One of the oldest and most straightforward tools is inflation. When governments spend more than they collect, they face two options: either raise taxes openly, which is politically risky, or quietly devalue the currency, reducing the value of every coin and banknote. Ancient Rome mastered this in the 3rd century AD. Facing military expenses, emperors reduced the silver content of the denarius, which eventually became mostly copper with a thin silver coating. The empire acted as if nothing had changed, yet citizens suffered. Prices soared, savings evaporated, and wages fell behind. This operated as a silent tax, and it continues today through central banks rather than imperial mints. During the Middle Ages, another method emerged: forced loans. Monarchs in England, France, and Spain routinely pressured wealthy merchants and guilds to lend to the crown. Refusal often meant fines, confiscation, or worse. Repayments, when promised, were late, devalued, or never arrived. Merchants had little choice, funding wars and palaces under the guise of patriotism or civic duty. This coercion proved effective for centuries. By the 17th century, the financial system itself became a tool for wealth transfer. The Bank of England, founded in 1694, was not charity. It funded wars against France. Wealthy investors purchased government bonds, and the Crown guaranteed interest payments, financed by taxes. Ordinary people, through taxes on salt, beer, and cloth, indirectly funded these payments. This system was a wealth transfer disguised as national finance, and it remains relevant today. Government debt is still one of the safest investments, with returns ultimately guaranteed by the labor and consumption of the masses. In the modern era, these strategies are more pervasive. Take overt spending as an example. Governments issue bonds to investors, banks, and foreign powers, claiming the funds go to infrastructure, jobs, or social programs. In reality, much flows to defense contractors, corporate subsidies, and bailout packages. When repayment arrives, governments rarely reduce elite spending. Instead, they raise taxes, inflate the currency, or cut social benefits. The trick is simple. Debt appears public, but the burden and profits go elsewhere. The 2008 financial crisis highlighted bailouts. Banks gambled recklessly, packaged toxic mortgages into securities, and nearly collapsed the global economy. Ordinary taxpayers funded massive rescues, while banks emerged larger and stronger. The tactic: privatize gains, socialize losses, and convince the public it was necessary to save the system. Pension and retirement funds are another subtle maneuver. Citizens contribute for decades, trusting their money will be there upon retirement. Governments often spend these funds immediately, leaving IOUs, promising future taxpayers will cover costs. This is effectively an intergenerational Ponzi scheme, sanctioned by the state. It works until demographic shifts make the system unsustainable. Reforms then reduce benefits, raise retirement ages, or erode payments through inflation. The pattern is clear. These methods rely on perception. People are told inflation is growth, forced loans are duty, national debt is investment, bailouts are stability, and pension cuts are reform. Language masks the truth. Wealth flows from the many to the few. History shows this works because most people do not study economic history, often recognizing the trap too late. Modern tools are more sophisticated. Consider quantitative easing, largely unknown before 2008. Central banks created trillions buying government bonds and mortgage-backed securities to stabilize markets. Politicians assured the public it was necessary. Asset prices, stocks, real estate, bonds soared, primarily benefiting the wealthy. Average households saw minimal gains but suffered from distorted markets and rising costs. The tactic, money creation, rescues elites while fueling inflation and inequality. Another method is hidden taxation. Instead of raising income taxes directly, governments collect revenue through sales, fuel levies, and especially inflation. When prices rise faster than wages, the difference acts as a hidden tax on savings and purchasing power. Inflation reduces the real value of government debt while eroding citizens' financial freedom. This is deliberate. It shifts the cost of spending onto the public without acknowledgement. Regulatory capture is another long-standing tactic. Regulations appear to protect the public, yet industries consistently influence regulators. Railroads in the 19th century, oil companies in the 20th, and today, tech and finance sectors shape rules to their advantage. The public sees protection, insiders see profit. It reflects a historical dynamic. Control the referee, and the game favors you. War financing is another recurring strategy. In World War I and II, governments issued bonds framed as patriotic duty. Citizens believed they were supporting their nations, while wealthy investors gained risk-free profits guaranteed by future taxes. Today, trillions spent on conflicts benefit defense contractors, banks, and bondholders, financed by debt borne by ordinary taxpayers. The tactic: wars appear temporary, but financial burdens last generations. Governments also weaponize complexity. Thousands of pages of tax law, intricate financial instruments, hidden budget items, and jargon create an environment where citizens cannot track money flows. Complexity becomes camouflage. Wealth transfers are hidden, making resistance almost impossible. In ancient Rome, devalued coins physically revealed the trick. Today, it's embedded in obscure programs and accounting entries. The tactic remains: hide the mechanism so the public cannot see it. These tactics matter now because they are active and accelerating. Inflation erodes savings, debt grows, markets wobble, and bailouts appear reflexively. Central banks manipulate the money supply, and governments shift costs to the public indirectly. The result is a system designed to keep ordinary people working harder for less real wealth, while financial elites grow stronger. History shows these strategies persist and recur. Roman citizens lost wealth from devalued coins, merchants were impoverished under forced loans, and modern households bear the burden of inflation and debt. Different eras, same mechanism. Most people never escape because they do not see it coming. Inflation is accepted as natural, taxes as inevitable, bailouts as mercy. Belief in government messaging over economic history is the most powerful trick of all. Forgetting the past ensures its repetition. Financial literacy is resistance. Understanding economic history is a weapon. Recognizing these patterns of monetary control makes it harder to be misled. Observing resource flows, identifying hidden pressures, and understanding mechanisms are essential for protecting your future. The financial maneuvers that devastated Roman citizens operate today. The difference is awareness. History provides lessons, and grasping them is crucial for financial independence. Strategies for awareness. 1. Look beyond appearances. When new policies are announced, ask who benefits. When prices rise, recognize policy, not luck. When regulations appear, see who authored them and who profits. Building resilience. 2. Acquire value. Outside the system, invest in assets that retain worth even as currencies fluctuate or government policies shift. Focus on tangible, self-sustaining wealth. Protect your future. Third act, independently of the system. Economic structures exist to preserve themselves, not individuals. Cultivate awareness, question assumptions, and use history to guide financial choices proactively. History may not repeat exactly, but ignorance ensures its lessons go unheeded. The schemes that ruined Roman citizens can drain modern accounts, cloaked in contemporary language. Recognize the forces, prepare wisely, and act with informed foresight.